Okay, so welcome back to our next session. First up, we have Asgeir Torfason. He is an assistant professor of finance accounting, a former member of the Icelandic Council, and a longtime money viewer. We're all used to thinking about central banking and monetary policy, but Asgeir will talk to us about a fiscal perspective within the money view. Take it away, Asgeir.
Yes, thank you. And I'm both a former assistant professor and a former member of the Fiscal Council. So what I'm trying to do here is an experiment. And so bear with me. It is a work in progress that has been developing from, following in the step of Perry, trying to develop it from the teaching that I've been doing with Sasha and Jay. In Torino last year and with Sasha, Jay, and Maria this year, challenging myself to try to, bring in the fiscal perspective and try to extend the money view with what I've learned from these 6 years in the Fiscal Council and what we have also all learned, I think, from the changing world of the pandemic, where the fiscal authority had to step in what I would say in a similar way as the central banks had to step in the crisis before that, into those days. So this is my try, and in the experimental manner, I'm even trying now to share my slides from my iPad, and I'm going to try to draw on them. So maybe this whole thing fails, but let's see. And you should see my slides now, I hope. Okay, so just a quick overview of what I forced myself to try to write this down after the two experiments in the classroom. Sorry, please mute yourself. Yeah. So what my goal here is that when we say fiscal, I'm talking about the Treasury or the Finance Ministry. It's called different things in different countries. And as we know from the money view, we can always add balance sheets. We can, traditionally, we have been adding them in between as dealers or additional players on the money market or the capital market or the financial system as a whole. That is for those of you who have taken the course by Perry on Coursera, where this all comes from. And traditionally, we have the central bank there somewhere, and it's like the one holding the highest powered money, and it is the banker's bank, so higher in the hierarchy than the banks. But what I am adding there next to the central bank is the Treasury. We could consolidate them in some accounting view, and we can debate. Me and Jay started a debate that I expect us to be having for maybe 10 years, whether the Treasury or the central bank is higher in the hierarchy. But for the sake of this experiment, I'm going to keep them on same level in the hierarchy. So borrowing from Stefan's presentation yesterday, it's horizontal, and let's not try to make it more vertical. But that needs to be debated, and I think that can even be changing during time. But what we know from the central bank's balance sheet, that on the liability side, there is these reserves or the deposit of the bank. The banks put their deposit into the central bank, and that's on the liability side of the central bank. Of course, that is the asset of the bank, but there is nothing there in pure accounting terms to balance that on the balance sheet of the central bank. And what I'm trying to draw your attention to here with this philosophical view of money is that actually the counterpart of that reserves is the asset of the states. So I'm gonna, for the sake of the argument, think of all the assets of the state. You can think of all the hospitals, all the roads, or whatever. But also there is this drawing again on Dan Nilsson's good presentations from yesterday, these implicit things that are not on any real balance sheet, but are definitely, we can debate whether they are off balance sheet items, but they are at least what some of them put in italics. It's an asset claim of future revenue, which is like the simple definition of what an asset is. The claim of future revenue for the state and for the finance ministry is the taxation of the future. And that is an asset-like item, because you can, like the bank can, have with their bank loans as assets, and they claim the future payments of that loan. And this is the key of the alchemy of banking, how the banks can extend their balance sheet. On the Treasury side, this is the future claims that can keep the economy going and make sure, without me wanting to go into any churches or any specific groups of MMT or anything like that. This is what is really creating the source of funding for the state. And then, of course, it can borrow as well. And here, a small accounting caveat is that just like how the equity is a residual balancing item of the difference between assets on the one side and liabilities on the other, the deficit is a residual of the usually minus of the cost minus the revenues, and that needs to be balanced with additional borrowing in the future. So the key concept here that I'm trying to introduce into the framework of the money view is the tax as the sources of the public spending, and this brings in a time factor because it's the future. And but my argument is that when the tax claim of the state as an asset, it has a corresponding taxing liability of the private sector. And if you are having trouble with this, think about it in a mirroring way of a pension. And a pension fund, it has the pension liability, the claims of the future pensioners. And that is an implicit asset for the household or for the savers. They have the claims of future payment from the pension, and that is a kind of an asset. Now, the deficit that is calling for the governmental borrowing, here for the simplicity, I am going to split up the governmental spending into what they use for the operations, like think about that as paying the salary of the doctors and the teachers and all the employees. And that's the operational, like monthly spending of the government. But then they can also invest in a new hospital. And here, for the simplicity, I'm going to say then the government can issue bond and borrow money for the investment, whether it's a new road or a new hospital. But of course, this all is blended up in the actual accounting of the state. But just for us to clarify the concept and visualize this within the framework of the money view, we say that the tax that the government collects every month goes into paying the salary of the government employees every month, but the issuance of new governmental bonds goes into investment of some new items like a hospital. Then two more concepts for this. Of course, here we have to think about the policy. We are all familiar with the monetary policy of the central bank that is affecting the financing condition in the financial market, but what I here then bring in is that we have to take considerations of the fiscal policy. So how the government is deciding to spending, how much it's deciding to have in deficit, and how much is going to borrow. And there is a future path for investigating how much goes into into the deficit from actually operations and not investment. But that's the golden rule and a big long discussion. So that's why I have been simplifying it. The government here is a key player. I'm having it represented with the Treasury or what I call the Finance Ministry for the model. But my claim is that actually it is much of a bigger player in the payment system than we have like generally looked at. And here I remind you of this important historical view that became then apparent in the pandemic, but what I learned from Perry and these economic history importance is that the role of the central bank is double. It is the banker's bank, but the central bank is also the government's bank. And this is what I'm trying to bring into the framework here as well. So for simplicity, again, of course, the government can have a bank account in a normal commercial bank, but for the modeling or drawing this in the money view framework, let's say that the government is paying its salary through their governmental account. This is different in different countries, but like there they transfer the money from the treasury into the employer's salary account in a commercial bank, and this then affects transfers of reserve or higher powered money. And then, you know, we have to think in normal times, you know, the government is paying every month all these huge salaries and getting tax payment, you know, so it's going in both directions. But then we have the additional role of the government in crisis time, whether that is the financial crisis, where it was differently involved in different countries, whether we think of the pandemic, where the role was quite big, especially where automatic stabilizers were smaller, like in US, where you sent out checks, and then in crisis time, like war times, you know. But again, for the model, I'm trying to keep it simple, and that the tax is going to be the source of the operation, but the tax account, you know, I'll just point you to this. It's in a computer system, and it is similar to bank accounts, you know, where you get your tax claims, or if you are getting repaid from the government. Normally, nobody thinks of this as a bank account, but it actually, at least in the countries I know, Sweden and Iceland, it can even bear interest, you know. So if you owe the government your tax, you have to pay interest on it, and if you paid too much and they owe you, you sometimes get some small interest on this tax account that is in the state accounting system, but actually not in any bank that I'm aware of. The borrowing of the government for the investment and for the deficit is then, of course, affecting the financial system, because this is such a huge player, and it is affecting borrowing condition and even cost, you know. So this is why the interplay or interaction between the monetary policy and the fiscal policy is of so much importance. And this we started to see in the pandemic. So that is why I became more and more sure of the importance of trying to do this. So bear with me now. And how am I doing on time? Sorry.
Yeah, you have like a minute just to wrap up as quickly as possible.
Yeah. So like what I did in the classroom, and I'm not going to do here, is to draw out, but you see it like just in your mind, and we can do that later. The example of taxation. So for the salary of the doctor in the hospital, the government pays his salary, but then for funding this spending, the government is collecting salary tax of all other salary payments in the system, and even actually also of the doctor's salary. So part of the spending there goes directly back or is netted. The second example for borrowing to invest in a new hospital, there we need to add players. So from the finance ministry, the debt office of the government issues new governmental bond that are then bought by the pension fund of the household in order for the government to pay the contractor to build the new hospital, and this goes through the banking system and the central bank. And then after the contractor has created this new asset, the new hospital, that becomes a new asset of the government on the asset side of the balance sheet. And the sources for this is the borrowing of the debt issuance. And then we have a whole lot of other future further issues for the future regarding the time factor, the off-balance sheet items that I mentioned in the beginning, valuation and prices, inflation, and based on the morning session, I mean the global extension with both sovereign debt, foreign exchange, balance of payment, war finance, Eurozone. There are huge implications of the fiscal in the broader picture. So this is just a first start of trying to innovate or do something that I hope I get some good feedback on and can develop further and try to. I think I stopped the presentation now, or?
Okay, thanks, Asgeir. We'll go to Jay Pocklington, our discussant.
Great. Thanks for having me as a discussant. Thank you, Asgeir, for this presentation. It's been a long time coming. I'm glad that you have also provided this morning a paper version of the presentation for me to review. For the sake of the audience, just to clarify, I think, let me just restate a couple points to make sure that we're on the same page. First of all, definition of fiscal policy and monetary policy. We would define monetary policy in the money view context that we're trying to change and ease or tighten monetary conditions. That's about how payments are made within the system. Are those easier to make or less easy to make? I think that's the sort of very short definition in the money perspective. Whereas fiscal policy is the government buying and selling as an agent in the economy. So that's direct cash. So that would be what we call spending and investment in the economy. You brought up the example of the pandemic and the fiscal became important. And let me just give us an example how, based on these two definitions, the fiscal dimension becomes important. We had both, I think, problems in monetary terms, in terms of liquidity terms, but we also had sort of problems that could only be solved in fiscal terms. I think there are two crises that were dealt with. The first one is, of course, liquidity crisis that was dealt with central banks, especially the activation of the liquidity lines. We all know that story. So the central banks acted in concert to quench out any existing, the first problem, which was to be solved about promise to pay that had already been made in the past, that those could be served and made, that there would not be a liquidity run on those particular promises. And then the fiscal side, of course, comes in that we're now, any new spending in the economy, any sort of would have to, we were losing a lot of spending in the economy because of the shutdowns and so forth. So that's the government spending is sort of replacing some of that spending. So just to be clear that there's two crises that have an overlap but are not directly the same problem that need to be solved. So that brings fiscal policy into importance in the pandemic because we don't have any spending in the economy. And of course, there are many crossovers when agents are not making payments, new payments, they can also not serve old payments. So there's liquidity dimension in the middle here. So let me just clarify another point, and then let me get to the substantive comments I have. Where does the government enter into this money view perspective that we're developing? So I would say that the fiscal dimension that you mentioned largely deals with changes in spending and distribution patterns, and that sort of depends on the regulation or taxation, and that sort of shapes outcomes. So fiscal policy is directly trying to achieve certain outcomes with government policy. And that, of course, is now something we really need to account for when we think about larger objectives that we're now looking at, fighting the pandemic, the green transition, whatever we call it, a war, you mentioned a couple things. There's a certain outcome we're trying to achieve. That's really where fiscal policy plays a large role, because it can direct cash flow directly into the area we need to be active in, with a clear definition of the outcomes that we want. We can also, of course, let me get to now the substantive points here. We got into a debate what's more important, or what's sort of higher up in the hierarchy or not. I think in a very strict definition of the hierarchy of money and credit, you've said yourself that the central bank is both a banker's bank and a government bank. So that puts, of course, in the hierarchy of money, in a functional sense, the central bank high up, partly because the government and the Treasury itself largely will have to use the liability of the central bank to make its own payments. So we're all using those accounts. And you made some reference about who's in control. So this is like an extension. It's sort of in parallel. I like the fact that these are in parallel to each other. You mentioned in the paper a alchemy of money that was in reference to the pension funds. We should probably put this into a question here, because I don't think that there's true alchemy going on in the way you described it, because alchemy, the Perry describes it, is a swap of IUs, which maybe you do make it, but swap of IUs, of course, is a swap of promise to pay, which should enable us to create purchasing power to then make a payment later. I'm not sure how exactly this fiscal perspective enters into that sort of alchemy that you're talking about, without using, again, sort of the perspective of the classic, using the central bank as a borrowing capacity, which would then be the classic sort of stuff that we're doing in the money view. With that, the last comment I'll make, and there's many others, because this is there's a lot of things to sort of touch on, because it's such a you just finished this paper this morning, basically. Yesterday I presented, on the first day I presented this sort of idea in the money view that money is a form of settling debts. Finance is a way of valuation of enduring promises, and banking is a way of allocating new promises. I think this particular frame would be really helpful to figure out, to integrate into the fiscal perspective, because we might be able to understand where governments need to use sort of the government capacities in order to achieve their payments. And then I think if we separate very clearly that, I think in what Perry said yesterday, and has always been saying, when central banks are doing too much, there's a problem. So there's a clear function now to sort of separate out that central banks in a classic sense are trying to facilitate payments and trying to make sure there's adequate liquidity in the system to ensure that the payment system is functioning at a very crude level. Then it's also facilitating the government to achieve certain objectives in the real economy, quote unquote, real economy. So it all comes back to the three-tier approach, which is when the government itself is making new promises, making new payments, it's using banking. Those are new promises. Then it needs to fund those, or fund them, or have existing cash flow in through taxation to make it. So I think it's very consistent with the money view that the government is maybe its own sector. So that leaves me with my final comment. Maybe this point of taxation, you sort of said that taxation is its own sort of payment system. Maybe we should view that as a provocation to the group as its own sort of wholesale money market, because that's maybe the one innovation that I do see we can pick up here, that there is something so substantive here that taxation could be its own integrated money market that is not necessarily intermediated by classic banking the way we were thinking about it. But those are my comments for now. I hope those are helpful to advance the conversation. Obviously, glad that Asgeir finally put these thoughts on paper to keep developing the fiscal view on the money view. Thanks.
No, thank you, Jay. I liked all the comments. I mean, and with respect to time, I just want to hear if there are some other feedback without going into big debate with you now. We can do that online to keep to the tight time schedule of the program. But it was a good to have the pressure of putting this out and down. And thank you and Sasha for putting that pressure on me, and it's obviously just the first step, but it's important first step. So I'm glad to hear. If yeah,
all right, go ahead, Perry.
So I'm just sharing one slide here from the Warsaw lectures that I gave about stabilization policy, where just to say that as far as I'm concerned, everything that I've heard from Jay and Asgeir is consistent with the money view, and it's exactly right. So what Jay was saying here, so he was talking about monetary versus fiscal policy. So this is what I said, I don't know, 7 years ago. Monetary policy works by relaxing and tightening the survival constraint, direct consequences for the money rate of interest, because the survival constraint is the overnight rate of interest is the shadow price of settlement. So that's direct. The fiscal policy works directly on cash flows and cash commitments. If you think of the world, of the economy as a cash inflow, cash outflow thing, the government spending and tax receipts are the counterpart of that, are cash inflows and outflows in the private sector. And so that could have a distributional consequence. It could have, I mean, it's so depending on who is being impacted here, and that's going to have indirect consequences for the money rate of interest, because you're changing the pattern of surpluses and deficits in the rest of the economy. So that's all I will say, that it's acting as an actor, a large actor, that's able to move cash flows and cash inflows and outflows around directly. Stop there.
Okay, Alex, do I have a minute to react, or?
Yeah, you have a couple minutes here. Okay,
yeah, no, so I think I agree in principle with everything said, and also what Jay said, but where I think my nuance with Perry and Jay is lying, and this of course I obviously need to develop further, is this idea of the alchemy, that actually that the government actually could, in a way create this way of making you have purchasing power, and not with swap or IOU, but with, and this is maybe difference between different societies, but when you have a social security number in the Scandinavian countries, you are pretty much secure that the government will take care of that, you will not starve, so you will get a kind of some way of living, housing and food, and this is a swap of IOU with a future generation of taxpayers, or however we want to think about this in the framework. But yeah, maybe I'm stretching it too long there, so maybe I will cut it off later on. But this is the only kind of direct reaction where I thought I could see maybe disagreement. But we are pretty much in agreement, and I need to flesh it out. But I think it's an interesting exercise to try to build out further, cover the whole economy, and not just exclude or assume, because we are assuming always that the pension funds will buy the bonds of the government, so the market extension is coming from, and that's, I think, the key role learning from the pandemic that hasn't come through. These multipliers of the government have been totally wrong. IMF accepted that, so this crowding out and all these old style of mainstream economics is falling apart.
Just on this last point, Asgeir, just to clarify, this was not clear in the paper. You said this alchemy in pension funds buying treasuries. Could you explain exactly what this was? Also the thing that puzzled me, because alchemy in the money view definition is a swap.
Yeah.
How
okay.
You're defining it in that way too.
Yeah, so this is the problem of bringing time into accounting, and so there are two key. This becomes almost like the philosophy of money. There are and that relates to the inflation problem that we are going to address later on. But the pension fund, I'm sitting in an audit committee of a pension fund. The claims they have on their liability side is based on, how many people will die, how many people will need extra payment for being paralyzed, and this is calculated based on some rules, but this will have to be paid, and then they will reduce how much they can pay if they don't get interest on their asset side in the purchase of the so it's an example of into the future where the financing has been putting restraints. So basically you could say that all pension funds are broke, because growth of birth is going down, so they will never have enough money to pay all the claims. But I say, because it's a going concern and we are never going to close the shop, we're never going to settle all obligations and promises, it has to continue into time continuously. That's where the alchemy comes from, in the similar manner as for banks. If you pay all the loans up for the bank, it's dead, it's gone. If you close it, but it's based on
Okay.
the system always continues. Yeah.
So I think this is an interesting discussion. I'm curious to follow it further. Sounds like you're getting into questions of funding and stuff like that. But we should get to the next speaker.
Yes.
Next up, we have Gerhardt Kiko Kalterherberg. Kiko has worked in corporate finance and capital markets. He is a co-founder of LPFMI, which stands for Liquidity Project Financial Market Infrastructure. One of the most basic forms of financial market infrastructure is the institutional infrastructure supporting trade finance. Kiko is presenting today to motivate a research agenda into applying the money view to trade finance. Go ahead, Kiko.
Thanks, Alex, and hi, everybody. I am sharing my screen. Oops, I was on too early. Yes, so I am starting a journey into researching trade finance. I like it because it's sort of very applied, and I'm wondering if, I'm looking for a way to apply money view in this. As I am in the beginning, there were so many things going through my mind. I was wondering, should I present something fixed, or would I want to go with an open mind into this conversation? I opted for the latter. So thank you, YSI, and all the organizers of this virtual conference, namely Jay, for inviting me, and for Perry and Sasha, who gave valuable content and process advice. I am sort of another president of turning a YSI consumer of research into a producer of research. We'll see how that goes. So what's the goal? The goal what I would like to achieve with you is to get you on my level of trade finance thinking, or at least on a good one, if you are not familiar with that space of the financial system, which in turn would allow you to identify as a potential collaborator, or share pointers and ideas on this, sort of connecting up with the introduction by Alex, sort of chipping into my research agenda in this. This could be research questions, hypotheses, data sources, journals, research papers, academic institutions for positions or collaboration, or really anything. It's the whole suite connected to research. On the agenda, so how are we going to do this? I am going to introduce some very few information about myself, which might allow you to see blind spots or basically where I'm coming from, and to judge that. And we're going to continue. I'm going to continue and just give you my disciplines of interest, which I guess I clear. And then I'm going to give you 2 exemplary research questions and hypotheses, but really just to get something out. I wasn't sure if this is a good idea, because I'm really open to anything that comes through your mind. Then I'm gonna do a trade finance primer. So I'm gonna give you some information which I think would be helpful for you to get to the goal, a timeline, and then sort of hope for a conversation afterwards. All right. So I have a degree in economics, a master and bachelor in economics and finance. I have, as mentioned by Alex, work experience 15+ years, mostly in corporate finance, as well in the capital markets. In terms of YSI, since we are at YSI, I was part of the first MOOC of yours, Perry, and the first batch that took the MOOC in 2013. I was participating my first conference at the Dutch National Bank in 2014, Evolution of the Global Financial System. The first webinar I gave was on the budget paper in 2015, and I, as already mentioned, am a co-organizer and co-founder of LPFMI, and that was in 2018. And I'm going to continue doing that. All right, so this is just to help, just give an idea. So disciplines, macroeconomics, money view, and law, and that's the primary interest of mine at the moment. Exemplary research questions. One could be the role of foreign exchange risk and how it might constitute an additional hurdle for emerging market financial institutions to offer trade finance products to their local customers. So there's Brazil. So there's a public actor in Brazil. They're taking off the FX risk for any players in the market because the central bank would step in on the FX risk. And so what's the consequence? And that is therefore facilitating trade. Another example could be the role of public export credit agencies in the calculation of trade finance risk premiums. So the hypothesis could be ECAs, in short, and enable trade by reducing trade finance premiums to competitive levels by taking on credit/political risk. All right, this was just to tease you or get you in the right mood. Let's go into trade finance, into the primer. So what is trade finance? When two companies trade a product or a service which require a certain time after completion, basically it leaves company A and it needs some time to get to company B, there is this delivery time, and the question of how the financing or risk sharing of that time is going to be taken care of. So there is the first option, that it's interfirm, which is called sort of trade credit, where either the exporter is doing it as an open account, think accounts receivable, or it's the importer who takes care of this, and that's think sort of an advance payment that the importer would pay that already before the importer had received the product or service. And then there's option number 3, that has been taken care of by a financial institution, and that is the bit I'm going to be focusing on, and that's called trade finance. So it could be banks. It's mostly done by banks. There's a lot of trade credit insurance happening, and there's other forms of trade finance, as for example market-based lending. Just as the way of giving you a feeling of why would you use one over the other. Trade credit, the interfirm bid, it has lower fees, obviously. It has more flexibility. It doesn't rely on a standard product. It has also more payment risk on whoever is financing it, and there's also a need for more working capital. Second, it's more likely for trade credit, meaning interfirms doing it, if there's an established commercial relation, trust, or in jurisdictions which have reliable legal frameworks for receivables collection. Number 2, significance of trade finance. trade signifies an important engine of the economy and its development. It's more than half of world GDP is constituted by trade. So I put here an average of 2017 to 2021 to get the number out. But it's trade is an important part of world GDP, and of that trade, about more than 1/3 of it is happening through trade finance, or sort of in terms of world GDP, you have roughly 1/6 of it is supported by trade finance. So configuration of trading and trade finance policy is a key area, I'm arguing, and it's in the real world, and you have both private and public players which are active in the field. All right, so numbers. This is just to really back up this by numbers. I'm just gonna focus here on bank intermediated trade. It's in 2019, it was
Hey, Kiko, I just noticed that there's a request in the chat that you go into slideshow mode so the slides can be bigger and easier to read.
Like that?
Great, yeah, there you go.
If it's only so it's going to be so easy to take care of all these requests like this. So yes. So with this slide here, the thing that I would want to get across is just to get the number out. So it's a bank intermediated trade is an annual around, it's an excess of $9 trillion US. So all numbers in the presentation I've tried to, no, they are in US dollar trillions to stay sort of with the magnitude. And so I think that's a big market, $9 trillion US. The insured bit, which is here the number, the fourth row, is sort of an excess of $2.5 trillion US. So moving to the bottom, global trade finance products, which are key ones. The biggest ones are letter of credit, a loan, a trade loan, or guarantees, which is sort of the insurance bit, have very low default rates. So you go through all kinds of reports. They're always below 0.5% on average, which is very, very little. Has also to do with the notion that they're usually collateralized, and that they're also, the de-risking factor is that they're just very short term. It's on average a 90-day product, or sort of to maturity. On the right-hand side, just to give a touch on sort of trends, a big trend for a decade or longer, it has been the notion of there's a trade finance gap of in the area of 1.5 trillion US dollar, and it's grown actually bigger. The World Trade Organization has been working this for a long time. They're doing more and more on the public side, but the gap sort of gets bigger, especially now with the recent pandemic. Reasons are unbanked. The emerging markets are underbanked. There is, of course, a lot of SMEs who require trade finance, but there is very little SME focus. And there has been recently also a reduction of banks who are the primary provider of trade finance in their reduction in correspondent bank network, which sort of is assumed is sort of playing into this problem becoming bigger. Supply chain finance, many people have heard it. I haven't found a global number, but it's probably very, very small at the moment. But what that is all about, it's a part of trade finance where financial players would sort of take a corporate, a large corporate, or a corporation, and then give the supply chain all the way down trade finance based on the credit premiums of the large corporate. Sort of, you have one on the top, and it can, or the supply chain lower down, small SMEs can use the credit risk profile of the large corporate, and that is called, and that's a relatively new phenomena, it's called supply chain finance. And then there's been a digitization of trade finance processes, mostly because of the pandemic. It has facilitated that. All right, public angle, something that I'm just gravitating towards, and to get that out in trade finance. You have obviously bank regulation, which as banks play the biggest role in trade finance. The way that the regulation accounts for trade finance is a huge lever. There is the national crises intervention frameworks are available. You've seen this through the COVID crisis. You have seen it in the global financial crisis in 2008 and 2009, that national banks, central banks have intervened specifically in trade finance markets. That is not because they are systemically risk factors in the sense that if a bank would not fall because of trade finance, but it is a conduit of financial crisis. That's how the BIS calls it, because if trade finance would go further down than necessary, it would sort of facilitate a crisis, and that's the angle that specifically central banks take in this. There are active players, active public players in trade finance, both in sort of products directly, the multinational development banks or the mentioned export credit agencies. I think here, just to touch on this, you see MDMs, multinational development banks, play a very small role in the overall trade finance market, and ECAs, on the other hand, in sort of coming in excess of $500 billion annually, play a much bigger role in this. Sort of from the primer, this is the last page, and this is just in stylized matters to think in balance sheets about this. I was not able yet to confirm these statements in any detail at this moment, but you see here on the top row sort of a bank intermediate trade finance. The one thing to mention here is that there is evidence in research that banks sell or take sort of insurance for some of their trade finance products that they have given out to the market. On market-based lending, there's evidence that exists, but it's all small. There was a sort of a bond, C-Lane, a couple of bonds in the approximation of $180 billion, and that's sort of a note, and that's an option. And then there's market-based lending, extremely small, it's called MAPS by Citi and Santander, where they securitize trade finance loans and make an ABS product, and sort of and I've put that down as a consequence how that could look like. It kind of focuses on likely how or the question of how the risk in foreign exchange and credit, the credit risk is being dealt with. I'm trying to wrap this up and for myself until the end of June, and see if this is a viable path for research in this field. And that's it. Thank you for your attention. If you want to look me up on the YSI directory, just put in Kiko. The references, I kept them very limited here. There's more if you want it, if you're interested in, for the recording, and any sort of feedback or conversation from you, Alex, or from the rest are much appreciated. Thank you.
Okay, thanks, Kiko. I will try to be pretty quick. I like the topic of trade finance because, as with the price level, it is another kind of connection point between the money side and the real side. And the reading group we just read, Kindleberger's Financial History of Western Europe, and he tells a story about how trade finance evolved into banking and bank money. That it can kind of evolve in a lot of different ways, but this is kind of like the main way that he follows. So it's really central. I think trade finance is really central to money and banking. If trade finance is failing, then trade is failing. So yeah, this is, I think, throwing the money view at it. I like that you started working on some, a stylized balance sheet view of trade finance in there. And if you can flesh that out and and polish it up and get it to a point where you can explain trade finance to me like I'm five, like I'm a 5-year-old who's taken Perry's MOOC. I think that would be really valuable to all of us here. So yeah, as always, the closer you get to the real world, the messier things get. So it's nice to be able to stylize enough to get the insights into how trade finance works and what kinds of issues it has. So I like this idea. You have this 2014 BIS report on trade finance, and it talks about how disruptions in the financial markets can be transmitted to the real side through problems with trade finance. So yeah, let's go to other people. Anyone who has any questions or comments about anything Kiko said, or advice or thoughts about his research agenda. Let's go to Asgeir first.
Yeah, thank you, Kiko. I really like this presentation, and I understand much better now which way you're coming from and where you're going to. I have 2 points only for this whatever happens in June. One is the historical part, that like the origins of banking in Lombardy comes from actually, merchant banks, trade finance, as I see it, to explain to the 5-year-old kid of Alex. That's how they started with banks. But then from the other angle I would like to point to is that the accounting perspective that I always try to advertise here is that, as I understand trade finance, I could be wrong, but that is basically exporting the accounts receivable, accounts payable in the simple accounting form of firms, where firms are actually lending and borrowing to each other and from each other. You get 30 days delay of paying the invoice for the rent or for the supplies that you need for your bakery. As I understand, trade finance is the exporting of that, of the balance sheets of these firms to a financial institution to take care of the part of the accounts receivable, account payable. So these are, I think, important pointers to think about and how I understand it, but look forward to see more later. Thanks.
Thank you, Asgeir.
Go ahead, Perry.
So to underline what Asgeir just said, in the MOOC, lecture 9, the world that Badgett knew, is a world of trade finance, actually, and it's a wholesale trade finance world. Maybe this is the addition I want to make. It is an interfirm kind of thing where the wool producer is selling to the yarn producer, is selling to the cloth maker, and so there's a supply chain that is there that has to be financed in some way. And it's a wholesale money market. So this is the connection with interest rates too. That this is where this is the and turning that into cash, these bills, involves discounting and the alchemy of banking and so forth. So this is where it connects, and it is really very fundamental. I hadn't thought about Alex's point that this is where the money view connects with the real side, but that's certainly true. Last point. Yakov yesterday, first day, made a very big point about this. That in the pandemic, the supply chain got all disrupted by pandemic constraints, but that had financial consequences because all of those promises to pay couldn't be paid, and then those financial consequences disrupted the supply chain some more. So that was a natural experiment, in fact, of an exogenous shock to this, and so and a lot of what Kiko was talking about is some various responses like digitalization and the trade gap, the trade finance gap. I think that's a great idea to be kind of focusing on that's where there's a public policy kind of frontier, and understanding why why that trade finance gap is there, and looking for other counterparties like higher up in the chain or the government or something like that. I think this is a wonderful research project. So I really look forward to the next several months. And I encouraged you when you were in my office, and you've made a lot of progress since then. So
in November,
this is going well,
Thank you. Thank you, Asgeir.
Okay, and I'll read one question from the chat, and then we'll go to Marta and get final thoughts from Kiko. So Ibrahim says, do you consider the political economy angle to this, because once it involves currency and institution, it's bound to trigger political interest? So you're thinking about the political economy side, and then go ahead, Marta.
I think that I'm coming from practical banking, and I was engaged in trade finance. So there are a lot of instruments, a full basket of instruments for trade finance, and they can use it. You can use it for export and for imports. It's one. The second, that if it's, you can agree that in exporters and importers can agree to payments delay to 19 or 120 days, but it's not like a trade finance. They only give two notes to the banks that, okay, I will pay later. But it's like a gentleman agreement, and there is not like a trade finance from the statistical point of view. And if there is a crisis, like for example, or some problems in trade chain, like today, or like in COVID time, you can find that you can see that the exporters and importers begin to use not the open payments, but more sophisticated trade finance or payments instruments. And I think that this tendency you can see in the last 4 years, and it's quite interesting. And my answer why the banks use the CDBC, it's because the banks has open positions, and in all the cases, in every currency, they have the limits and they have to close them. That's why they use the collaterals, for example, central and other instruments. Thanks. It's only this, but I will tell.
Okay,
Thank you.
Yeah.
Yeah. So on the first point or question, which was political economy and FX, I have not taken that thought in. If they're married together too much further, things that come to mind are of maybe these multinational development banks or World Bank that are doing this. I'm not so much interested at the moment at political economy, but of course it's right that whenever you have FX or when there's a trade between two nations, then of course it has to do with sort of ideas of sovereignty and political spheres. I'll have to think about that. And in regards to the second comment, I'll thank you. I'll definitely we'll hear the recording on this one more time, but it seemed like there was good pointers in there. So thank you.
All right. Thanks, Kiko. Thanks, everybody. That's it for this session, and I'll hand it back over to Jay.